Hello and welcome to Invest with Rules. It's Wednesday, April 9th, the midweek update. I'm Scott Bennett with the great Mike Olafson. Mike, happy Wednesday. How are you doing today, buddy?
I am doing well, Scott. Good morning. Good morning to everybody.
Thank you. And so we're elite. The mission today is we are going to peek under the hood. We're going to talk about the markets. We're going to talk about some of the difficult items going on in the markets, how we're positioned, what we're looking at, and why. So that's the agenda today. And before we do, world's quickest disclosure, this is just information. It is not a direct solicitation to go buy or sell anything. Please, please always manage your risk, follow your rules. There's a lot of risk out there. We'd love to be helpful to you in your research process. We're going to start with the stock market score, and we're going to talk more about how it works in a minute. But very simply, right now, the market, despite everything that's happened, a 1 is as low as it gets, a 10 is as high as it gets, a strong uptrend. We're at a 1. This is a very, very hard and miserable market. So if we look through the market very simply, this is the S&P 500. In full disclosure, we don't own it. I know it's kind of wild to say. Very simply, we have 15% exposure, and we'll share with you today what we still hold in the model portfolio. It's two small companies, but primarily it's gold, and who knows? We'll talk about bonds too. The S&P is on a break signal, meaning it's in a short-term and long-term downtrend. You can see the calendar day when that flipped. It actually produced another short-term downtrend earlier in the process in February. How we operate is at 3 o'clock we make our changes, and then after 3 o'clock there's a moment where it actually flipped back to a kind of an opportunity, but we didn't take it, and then it flipped back the next day. So very simply, we didn't take it. So you can kind of see the devastation. The short-term trend is down 12% since the most recent signal. The long-term trend is now down 10. This is a really tough market. Mike, do you want to cover portfolio heat and any thoughts you have?
Yeah, portfolio heat is basically the concept where it's what we estimate to be our maximum drawdown at this point. And the reason why it's so low today, less than 1%, is because we're so lightly invested and so heavily in cash, 80 plus percent in cash. So what it is basically an approximation that if the few positions we hold right now all got stopped out, this is what our portfolio would be down less than 1%. And typically what you'll see is when we're more heavily invested, you'll see that start to tick up. And we use that as kind of somewhat of a barometer just to make sure we're not getting too ahead of our skis.
Awesome. And again, we're going to show you how we're doing. We're going to show you everything. So stay tuned for that. So very simply, the stock market health score, I just want to reiterate what it is and why we think it's important. And it moves, so it's not static. So very simply, it's based on the three major indexes in the US and then the international index. So it's the S&P 500, it's the tech stocks or the NASDAQ, it's the small cap sector, it's international, and they're all on short-term and long-term downtrends, which throws it into a strong downtrend. It can change throughout the day. You will see if for members, certainly you can see this happen at times when it was going from a 10 and it really jumped down and it kept falling. So we use this as a kind of a barometer. It's a temperature. Should you wear a coat outside? Should you bring your umbrella? Right now it's a 1. We're 15% invested, but we're not invested directly in these individual kind of indexes, just to be clear. We are owning things that are non-correlated, like gold, as an example, or bonds. And bonds are having a tougher day to day, which we can talk about in a bit. But it's a suggestion. Think of it as a speed limit. Some people go over it, some people go under it. Totally your call. But we want to have an independent voice that's based on math that just says, hey, how exposed are you? Are you too exposed? Are you not exposed enough? Obviously, it's been really, really helpful. Anything I missed?
No, you got it, Scott.
Cool. All right. Now we're going to go to the market health. So overall, it's a busy slide. Off to the far right is what's acting the best over the past roughly 14 days. Over the far left is what's acting the weakest. So you'll notice one thing very clearly. There's pink everywhere, which means break signals, which means short-term and long-term downtrends. This is crazy, right? Everything On the major stock indexes, so these are sectors, broad-based, they're all in short-term and long-term downtrends. This is why we are so defensive. If we go a row down, this is the top 15 roughly of the largest companies in the US, and most of them are global despite the joy of tariffs. So all the way to the far right, you have United Health Group, which is on an overheat or it's on a gas signal that's gone up so much that it says, hey, pause, be patient. Um, Up 2% today. It was up really big earlier this week. And you have Berkshire Hathaway on a coast with Visa and Walmart. Everything else is on a break signal, and you've seen just utter devastation. And you'll see this red line, the short-term volatility adjusted momentum. If you go back 30 days, if you account for volatility, what are you down? It's pretty ugly out there. So despite all fund manager buying or despite whatever, we follow trends, and the trend says be really careful. So I'm going to keep moving unless you have any comments.
No, you're good.
I'm going to stop right here. So we are really transparent. Most newsletters are not. So I want to be really clear that a lot of newsletters simply say buy something and hold it for 3 to 5 years and hold your breath. That's not us. A lot of newsletters don't even show you their trades. They just kind of like say that here are the good trades. They never actually show you what they did, why they did it, and their process. So we are a little different in a transparency, and we're not perfect. I want to be crystal clear. No one gets every trade right. The only one who ever did was Bernie Madoff. So the invest with rules model, I'll just shorten it for IWR, but invest with rules model, we are year to date down around 6%. That still makes us sick to our stomachs. We don't love it. We're not thrilled. We strive to do better. But in perspective, the market last Friday was down roughly 6% on so many different asset classes in one day. So because we've been so defensively oriented, we're down 6% year to date. Relative, so comparing us to other things, we are doing better than, as an example, the 60/40 mix, stocks to bonds, better than other trend following operations, where the S&P 500 year to date is down 15, tech stocks are down 18% year to date, small caps down negative 22. We're now into the darker red camp. The semiconductor index, the SOXX, is down 28%. The ARC, remember Kathy Wood, who crushed life in 2020. She owns Tesla, she owns CRISPR Pharmaceuticals, she owns all this like really exponential, in theory, futuristic things. She's down 29% year to date. So roughly almost a third gone. So the question then is, okay, so if you lose a little, so we are going to have losses, keep them small, let your winners run. So as an example, what we would need is a very small denomination. So if you lose 5, you need 5.2 to get back to even. If you lose 15, you need a almost 17, 18% return to get back to even. And then let's go down. Once you get past that 22 to 29, you need a third, a 33% to roughly a 42% return to break back even. We have the ability, because whenever you have these horrible deterioration, on the other side of the road or the rainbow, the markets are going to explode out of this at some point. Soon, the market's telling us not yet. But in general, at some point, so we can easily recover from being down -6 versus being down -29. So we could recover in a few days, we could recover in a few weeks, but we can recover fast, but we're not thrilled. Mike, I'm going to have you take over, but this is just why we follow the trend and why we follow rules. And this is a wild, horrible market that started at the end of February off the top.
Yep. Yeah, I'll just throw in one quick comment. Then I think we're going to look at one example of what's going on here. But the quick comment before we move on is that we talk a lot about, a theme in our videos is our process, the math behind our process, what we do. And this chart is basic market math that really any investor or trader needs to know. This basic understanding that, hey, this is why I need to preserve my capital, keep my losses small, and let my winners run so that when I lose, the winners kind of make up for when I lose. Because this chart tells it all. So I'd suggest members, if you haven't really taken a good look at this at some point, stop, maybe take a screenshot and have this printed out, because this is a key thing to understand. Plus, it makes psychologically, if you're, say, a member's down, let's say 10%, understand that that's okay. Well, it's not thrilling, right? But it's recoverable. Whereas if you're down 30%, it's a lot tougher to climb that hill and get back. So with that said, let's go take a look at a quick example, Scott.
Cool. So why don't you kick us off?
Yep, this is ARC, just to kind of show an example of what happens and in the market where we talked about it already being down close to 30%. And in fact, if you go to the peak where Scott was just pointing, it's at down actually close to 40% from the peak, which is really called drawdown. But the bottom line point is this is what can happen in the market during this type of devastation. And another quick example, everybody's I think heard the adage where the market or the stocks and ETFs take the escalator up and the elevator down. This ARC is a great example of that, where it took what better part of a year to get up to that peak, and what it's been about what a few weeks, couple of weeks to give so much of it back. Scott, anything you'd add?
It looks like a trap door, not an elevator. I would
Yes,
say,
yes.
I would take a step back mentally and just think like if you haven't perfectly followed your rules, we're all guilty to some extent that we believe in a position, we get busy, things happen. It's totally normal. But just step back for a second and just think like if your car got smashed today, you have car insurance. And if your house was like knocked over, you have homeowners insurance. And these are things that are like critical in your life and you've saved for years and decades. Why doesn't your portfolio have rules to protect against devastation? Because we know it happens. Sometimes it's once every 10 years where it's down 50%, or maybe it's you lose 20% every, I don't know, 3 years or whatever the math is. But the reality is, like, even the beloved Warren Buffett has whatever it is, 40, 60% in cash because he thinks this market's stretched. So even he has some sort of a seatbelt mechanism. So just think through in your world, like, why am I not protecting my account with rules? Like, why am I not doing it? And then try to justify, like, like maybe if you're like 20 and you have the road ahead of you and you can say like whatever, I can lose a few $1,000, like no biggie. But like for most people that's just unnecessary and the emotional hit to this is awful. So very simply, our process, stocks come into play a little bit, but in an environment like this there aren't very many stocks left over or even on gas signals. So we have our stock list. We are looking for fund buying. We're looking for earnings growth. We're looking for volatility adjusted momentum. And then now we throw in index funds into our trend roadmap analysis. And we ask the computer models that we built show us U-turns that are the short term is now coming back while the long term's down, but really show us gas signals, short term and long term uptrends. Show it to us. And it's shocking how few there are at this moment. And then we play defense in topping patterns. We call that a coast. And we run for the hills on stage four declines because this is what the market just did to us. It was a stage four decline. It was a break signal. It's where all the torture happens. Before I want to move to the next slides that we actually sold yesterday. This is a monthly chart of the S&P 500. This is your peak of 2021, 2022, and this is your 20% bear market that we experienced. And we've had roughly 2 great years. Here's your cup, here's your handle on a monthly chart. We've had 2 great years of a run, and then it just topped this year. And then, oh my goodness, look at that fall. This is a spot that there would be a logical bounce, a logical capitulation. You have the support of the highs of 2021. You have a very meaningful trend line that hit. You can even go back even further. It hit the 2020 COVID low. It hit the 2022 low. We're here. If we get a bounce, now is probably the likelihood time for that to happen. Will it? We follow trends. So very simply, I want to be clear we owned a position in PSQ, which is the inverse of the NASDAQ or tech stocks. So when tech stocks fall, this goes up. And very simply, it was on an overheat. It's on an overheat today. And we took our profits and we ran. We like profits in a bad market. Short term, long term uptrend. I mean, look at that return. 22%. That's like, remember the movie The Big Short? You can have a small short, you can have a protective short. That's what we are trying to accomplish. We're not like necessarily a hedge fund, but we're trying to protect them during these really bad markets. I'm going to show the next one, and Mike will have you kick off. It is SH is the inverse of the S&P 500. So when the S&P 500 falls, this one in theory goes up. So very simply, we took some off the table. This is a logical spot for the market to do some version of a relief rally. Mike, any thoughts?
Only thing I'll throw in, Scott, is that if we end up having another leg down, and it's an if, but our plan, and we always have a plan, we don't know necessarily what's going to happen, but we always have a plan. So we've been using the hedges as kind of that insurance, like you referenced earlier, but they could become trades to create, basically to help bolster the portfolio, similar to what we did in 2022. We had a positive year in 22 because the market was so just decimated that the hedging became a truly profitable trade. So that depends on if we have another leg down. So just want to kind of give everybody a quick sneak peek of what could happen.
Yeah, so let's say hypothetically, and this is just
Yeah.
prognostication, is markets go up a little bit from here. So they bounce. There's a relief rally within a bear market. These are gaps. So you see how the market jumped up and it gaps from one day to the next. There's another gap here. Gaps tend to fill. We've talked about this a bunch on past videos. So we just don't want to be too piggy and just take our profits. But the question that I'm going to turn is, where on earth is the bull market? And this has been our stance for a while. We have a position in gold. Gold is performing well today. We have a full position. It's the largest position in our portfolio. IAU is the iShares Gold Trust, whether you like the State Street GLD or you like Sprott, their products, it doesn't matter. It's physical gold. It's on a short-term and long-term uptrend. It's doing really well this morning. It's certainly outperforming by a long shot, and we're always managing risk because at some point they could hit gold too. But here's a chart of gold. Full disclosure, we own gold. It's not doing anything wrong. It's just forming higher highs, higher lows. It's stair stepping. It's doing everything perfectly right. Short-term, long-term uptrend. It's back on a gas signal today. We already have a full position. That's something that we own and we've been happy with. We're up in the neighborhood of about 20% in our position. And this is a safety trade. And this could pull in at some point, but it hasn't. And it's acting strong today. Mike, any thoughts on gold?
I'll just point out the long-term uptrend, now well over a year into the long-term uptrend, 50 plus percent gains. And it just, for those lucky enough to have taken that trade, you've got a great situation with long-term capital gains. But to your point, Scott, it's doing nothing wrong. So we're going to watch it closely, but we're going to continue to hold it as long as it is acting as expected.
Yeah. I'm going to move. We have a position. It's a half position. It's roughly flat. It's not gone up a lot. It's not gone down a lot. It's IEF. It's the 7 to 10 year Treasury bond ETF. It's kind of think of it like the middle part of the curve. And very simply, this morning, it's on a short-term and long-term uptrend. There's lots of headlines at the long end of the curve, the TLT or the 20-year plus, that's getting hit. And it's getting hit because of multitude of reasons. And there's always a why, but does it always really matter? Are foreign economies selling bonds? Maybe, most likely. So they're kind of upset with the U.S. and some of the actions that were taken. But very simply, if this thing breaks, we just simply sell. We have a half position, and we're more or less flat. So the impact to our portfolio is like point zero point zero in a number, like one. It's like no impact whatsoever to the portfolio if we're wrong. So if it holds this trend line, perfect. If it dunks under and we just exit, I mean, we could always re-enter down the road, but this is a safety trade. This is a trend that's actually not looking terribly bad. It looks very similar to what's going on here, and today could, in theory, be if the low, hopefully it holds up for us. For our long-standing members of Invest with Rules, we have two positions that are up very large. Axon and Boston Scientific. The funds we're buying, the trend was there. We're up over 70 plus percent in both positions. If it was one of our, like in theory, this manage your own risk, but if it was one of our clients and they don't have very large gains, they're out of this thing. You have to have cushion to play. And if you don't, this is too violent. So, very simply, Axon Enterprises, so think taser, think a police officer has a body cam, and then you're paying Axon for that service of the body cam because we do live in a pretty litigious society. So, if something ever happened and you're like questioning the police officer, they have a cam that recorded the whole thing. They have drones that do like instead of like at some point in our future someone calls 911, it's not going to be like you don't know who to send. Like, do you send the police? Do you send the ambulance? Do you send the paramedic? You send the drone, and you get them there in seconds, and then it all reports back to what who do we really send based upon what the person on the
Yep.
phone is saying.
So
So
cool.
so Axon's that company, and the reality is that it's holding long-term support. It's still up very large. Short-term is down, but it's on a coast. So we have our cushion. We're watching it closely. Really don't want to see it break much below a couple days ago's low. But that's Axon. The funds are still buying. Um, Obviously, fund buying is important, but it's not as important when you're in a bear market. It's just the reality. The trends trump all of this fund buying because we want to see what they're buying to help us kind of move forward. But I think what's really telling is it didn't show up on our watch list. Maybe we're waiting for a little bit more confirmation, but what's showing up on our watch list is TJX. So if you think about like, let's take Macy's. They're trying to sell Ralph Lauren shirts in this hypothetical example. They can't sell it. They just offload it to TJX. The shirts are already in the US. There's no tariffs. The shirts are already here. So they buy them at a discount, sell them at a markup. That's TJX. And they're the only thing on gas on the billion-dollar fund manager report today, but we're still being cautious. So anyway, Axon. That's a little bit of a rant. So Axon, it would be great. Can it break out of this and then start to recover? That'd be super. If not, we're watching our stops very closely. Same goes for Boston Scientific. If you look at these charts on a longer term basis and you go weekly or monthly charts, there is nothing terribly wrong as long as you have a cushion. Short term is down, not bad. Long term is up, looking great. You're still going to have heart surgeries, and you're going to need devices. So it's still holding long-term trend. This is the 200-day moving average. We don't use that on our proprietary process, but in theory, holding it. Mike, any thoughts on our two half positions in Axon and Boston Scientific?
I'll just say this, Scott, that we've talked over the past, what, year plus a lot about these two companies. But the key is we date, we don't marry. So even though we've been in these for quite a while and we have basically moved in and out of, we've got a core position, moved in and out of an extra full position, we date. So we are not going to hesitate if BSX and Axon do end up violating our long-term signal and go to a break, we're going to have to stop dating them. And that's the bottom line is, and that's what we recommend to folks is that never marry something because you don't know what's going to happen. Kind of like that arc chart we saw before.
Yeah, we live in a capitalist society, and you need growing numbers. You need growing revenue, you need growing earnings. And the moment you don't, or the market does this, lights out. The party's over. Don't give it all back. So again, this has been a really hard market. We care about you greatly. If we want to say first, thank you for being a member. If you have any friends or family that are like, goodness, I need some help. We follow trends, we follow big money, we follow risk management rules, and really what we're really doing now is we're following trend and risk management rules. That's pretty much what we're doing. The big money is important, but the trends and the risk management are everything. So very simply, if you have questions, reach out hello@investwithrules.com. If someone else is out there in this world looking for more help, please share this with them. I'm not the world's best marketer. We try. And then finally, if you're like, raise your hand and you're like, I'm not following the rules. I need more help. Like I really could use more fiduciary assistance on everything from risk management, not just on my portfolio. And I can go sleep at night and know that these people are actually going to protect me without using expensive things, without using the crazy world of annuities. We just use low cost, super liquid investments. That's all we use. And it's super, super transparent. Just reach out hello at IWR Advisors, and we're happy to do a review. There's no obligation to you. Again, I just wanted to share that with you because we care. Again, we want you to do well, survive, because we would love for this market to bounce. That would be amazing. But what if there's a second leg down? Please, please follow your rules. If you have questions, reach out to us. Again, thank you so much for your time today. We appreciate you. Mike, final words.
Thank you very much for being part of our small but mighty community. We really appreciate it.
Love it. We're going to come back to you on Friday. Expect an email in your bin like you do every day. If you're not getting any emails or you're not seeing these videos, please just reach out to us. We care about you. We want you to do as well as humanly possible. Thanks so much. See you soon. Bye bye.